Hello guys, so welcome back to another video. So this video we're going to talk about order blocks. Now in terms of order blocks, now we need to understand why an order block actually happens before we actually trade it. And the beauty about trading using order blocks is that it provides a story for every trade that you take, which is why using this strategy gives you a bit more of a confidence and security behind the trade that you take, because there's got a complete backing and complete story behind it, and it's quite nice to have a reason for every trade that you take. So we're just going to delve into it. I'm not going to show you how to trade it, but at this point we're just going to explain what an order block is, and it's quite key to understand the theory behind order blocks. Right, so let's start off. So the story behind order blocks. Okay, so first of all, have you ever placed a trade off, like a retail trade, off a triple bottom, head and shoulders, a normal trend line tap, like the third tap of a trend line, you know, or whatever patterns that you've been using, right? And then price you get stopped out by like a wick, for example, or like a weird bullish or bearish move, and then price happens to go in your favor, and you always say, oh, it's a stop hunt, you know, you've been stopped out, you know, or the banks are against you, and that is true. The banks are against you, and they are the ones that move the market. Okay, we don't, as retail traders, we don't do a lot. Our orders are very minuscule, and we're always at a disadvantage because of this. However, the banks recognize how retail traders trade, and what there is, they look for areas of liquidity above. Well, they look for areas of liquidity above or below your orders, right? So say for example you set in a sell limit on your triple bottom, there's liquidity sitting where your stop loss is, right? There's loads of orders there, and you're not going to be the only one taking that trade, so there's a lot of liquidity there. And then what the banks will be doing, they'll be pushing trades to that level before moving it in the direction they've always wanted to go. It doesn't matter even if you're trading the trend using these retail methods. Not saying that they don't work, I'm not saying they don't, but you can refine your entries using order blocks. But this is just explaining that this is the reason why sometimes you get some random moves that take you out and then carry on moving in a direction that you want it to move. But the best way to sort of see it is that every trade that you take in terms of using a retail method, they are, even if it's like a very basic one such as a triple bottom, I'm going to use this one because a lot of people know it, such as that, for example, the third touch of that support level, the banks are aware, the market makers are completely aware of where people's stop losses roughly are. They don't know exactly, right? They don't know exactly where people put the stop losses. However, they understand where areas of liquidity are sitting, which is generally why retail traders would have a very big stop loss because of this, because they're trying to aim for below the low, or you know, certain reasons, like certain things like that. So what we're going to focus on is understanding why price moves and where it does. So in the next few videos, obviously you'll probably learn about inefficiencies. That's another reason why price would actually go against you, or price can actually be going to an order block at this point. We don't know. So as I've just explained, so understanding why the banks do this, because they need to grab their liquidity in order to basically feed their move. Okay, so even if you're right, the banks are going to take you out, grab the liquidity, and then carry on going. But the key thing to understand is that the banks don't use stop losses. Okay, so even though they've grabbed their liquidity and created a move, so say for example, and I'll show you an example, and we'll go through a couple. But say for example you have a buy limit and price just breaks below the buy limit. Okay, so price needs to move down, okay, before creating that bullish impulsive move. But in order to create that down move, as retail traders, we're not actually doing that. It's the banks. They don't use stop losses, so they would have to sacrifice the position to sell price down to grab the liquidity and then move up. So whilst they could be sitting at good profit, they still got that losing trade. But what does price need to do? It needs to come back to the order block in order to mitigate their losses. So they need to find a way to they need to bring price back down, because now they grab liquidity, however they still have that losing trade. They need to get closed at either break even or small profit or a very small loss, and then carry on their move. Okay, but where the price actually returns to is called the order block. Okay, so let's look at an order block. So this is an example. So what can we see here? So we've got a support level here. I'm going to call that equal lows. The third touch is where people will be looking to buy, but what happens? It breaks through. It breaks through and then flies up and breaks all these structures on the way. So price obviously grab liquidity. Okay, it's pushed up to the upside, breaking previous structure. However, what does price do? It comes back and then carries on going. But where does it come back to? It comes back to an order block. So I'm going to explain to you how to identify an order block and how to identify a bit more clearer. But essentially, what an order block is it's the last candle that creates the move. So in a bullish move, it's the last bearish candle that creates the move, and in the bearish move, it's the last bullish candle that creates the bearish move. Okay, so for example, this candle here is the last place that the banks have sold. Okay, so they sold at this black candle here before creating this bullish move. So that's our order block. So that's our point of interest. But what does price do? It comes back, mitigates it, so they can close their trade. They've probably closed in a small profit there, but I don't know. But they might have done, and then what's happened? It just carried on going, broke their high. Okay, so they're probably sitting. So for example, at this point they've sold. The first place they sold is that black candle here at the top. Okay, so they sold down here. Okay, at this point they are in loss. They're in profit. So they say, for example, they are 10 million in profit here, and they're coming down. They're probably about 100 million, for example, here. But then what happens? They're obviously placing buy orders and pushing price up, because this is where they want to take it. But even though they're in profit on the buy trade, they're in loss on the sell. Okay, but what this means is that they need to come back and mitigate their loss, because even though they were, say, 100 million in profit here, they're probably like in minus 500 million here. Okay, we don't know what I don't know. I don't want to even think about what their profits and losses are like. However, they're sitting in loss here, but they don't use stop losses, as I mentioned. So they need to come bring price down, and then before they could take it back up. So let's look at some examples, and let's try and explain it a little bit further of how to actually identify an order block the most effective way. So let's look at some examples of order blocks, right? So we've got a support level sitting here. Okay, what do we expect? Obviously price to come down and tap. This is what retail traders would expect. They'll expect it to come down, and then they can expect a bullish move, right? Let's see what happens. So price comes down, breaks, and then goes straight back up and breaks structure. Okay, now the last structure is obviously this structure, and then we've obviously created new highs. Now we need to understand what structure, well, where is the order block? Okay, the order block is the last bearish candle before the bullish move. Okay, now some would argue that it'll be this candle, which is the last bearish candle before this bullish move. However, we've had a little bit of a pullback before that even happened, before we got a break of structure. So our order block is actually this candle. I'm just going to highlight it here. Okay, so let's highlight it like that. So our order block is that candle there. Now what we're going to do is highlight from the wick to the wick. Okay, and that's our order block zone. Now there's different ways to understand how to actually draw an order block. Okay, but this is quite clear example, because the next candle that happens is an impulsive move and is a break of structure. Okay, and let's see what happens to price. Does it come back to this order block zone? You know what, I'll just do this. Actually, no, I won't do that. Let's just see what happens. We'll be patient. I don't think it comes back in the end, or does it? We'll see. Oh, it might do. So yeah, I'll show you how to actually accurately find an order block. So this one's quite a clear cut example, but we'll just check something. Let's see what happens. Let's go back out and let's find where it was. Oh, I didn't realise it this far back. Apologies for the delay. Okay, right. So if we zoom in, what happens? So price actually comes back to our zone and then flies from there. It obviously took a while. It actually took a considerable amount of time. Well, 3 days, so it's not too bad. But price has obviously come back to the order block and then gone. Okay, we would have had an entry at this point. Okay, this is how we have very tight entries. However, this is not just the way that we trade it, and the full method of how we trade it will be in the next next video. So what we're going through is actually how to identify a clear order block. So that is an order block there, and we've got a clear impulsive move. However, sometimes you get order blocks. For example, let's just see if there's one here before I do anything else. Right. Let's look at this point, for example. Let's just rewind it to here. Right. So I'm just going to go through a different time frame just to see if there's a good example to show you. No, not there. Okay, it doesn't show you that point. Bear with me. Right, so let's try find a clear order block. I'll just go back to 15 minutes. It's a bit easier to show you. Bullish candle, no. Here's another example while we're here. So another example of an order block, what we can see is that actually we didn't break. Actually we did. Okay, so here is we've got a structure here, and what has price done is actually broken structure, and it's left an order block which is sitting in here from that top of the candle to here, and that's an order block, and price obviously reacted and come down. Now I want to show you how to actually find how to actually refine your entries to an order block, which is quite interesting. Let's see if I can find one while we're here. Okay, so for example, if you get an order block, for example, we broke structure here, so our order block is this candle. Okay, so I'm going to draw, because that's the last bullish candle before the bearish move, right? Now, the next candle that happens doesn't actually impulsively break our order block, okay? It doesn't actually do anything. Now, what some people do is obviously go to a lower time frame to find another order block. However, what you simply do is actually move to the next candle, and your order block is now going to be that candle, okay? Because we didn't really get an impulsive move, and it's still within the range of the actual order block candle. This will refine our entry and prevent us from actually having to go to a lower time frame. For example, if we were to go to a lower time frame, let me see where I was again, and I'll just go back to this. It wasn't there, was it? There was it. If we go back to a lower time frame in this zone here, so let's go to this zone. We'll look in the 5 minute, for example, and what's there? There's an order block sitting there. Okay, look, there's an order block sitting there. There might be another one in the 1 minute. If it shows us that there's another one sitting there, and because obviously this one didn't break any structure, that would be the entry point. But it just shows that we don't need to go to a lower time frame. We just have to refine our entry from the higher time frame, so we can refine our order block using this strategy. So essentially what you need to find is an order block, and then the next few candles you have to look at whether it's breaking structure or not. For example, if we're looking, let's try find another one. Here, for example, this is another one. Okay, so we've got our order block before this impulsive move. So that blue candle is our order block. However, the next candle doesn't really create an impulse, doesn't really do anything. That is now this black candle there. That is now our order block, and there's potentially, let me go to here. Let's see if the data actually shows, if it allows me to go that. Yeah, there's an order block sitting right there, and then another one. So that's our order block in the 5 minute. However, we don't need to go that low because we've already identified our point of interest on the higher time frame, doing that without having to go to a lower time frame. Let's try for another one, because although it's nice to sometimes obviously get like clear order blocks like this one, and then you get a good impulsive move, so that's our order block. We don't need to do anything else to it. However, sometimes you do need to refine it, and it saves you from having to go to a different time frame to understand. Let me see if I can find another one for you. No, that's a clear one. Clear one. Let's have a look here. Another clear one. Normally there's quite a few, to be honest. Clear one, clear one, clear one. Okay, so for example, okay, there's another one. So, and this one actually shows a reaction. So say we've got a break of structure, which is here. Okay, we've got this break, and our order block is of, first of all, is this candle here. Okay, now let me just get rid of that for the moment. Right, so we've got order block here. Okay, the next candle doesn't break the range, so that's going to be our order block. Okay, our point of interest. And the next candle is also didn't really break the range, wasn't really impulsive, so that's now our point of interest. And as we've seen, what happens, price comes to this point of interest, reacts, and carries on going down. There's potentially an order block sitting, hold on a sec, let's go to this impulsive. There's potentially, please say it shows me, yeah, there's an order block sitting here. That's the entry point there. Let's see what happens. Let's go back to the 15 minute. What did that react to? Yeah, so it reacted to the 15 minute entry and then dropped. So it saves us from actually, from the 5 minute entry, sorry. It saves us from actually going to the 5 minute. Let's see the 1 minute actually. It might have reacted to that. Yeah, look, there's a 1 minute order block there. And the entry point is obviously would have been the next candle, which is here, which is exactly what that line is. There was no need for us to even go to this time frame because we've already refined it from the 15 minute entry, 15 minute point of interest. Okay, so this is how to actually accurately find and identify your order block. Okay, so you find your order block, look at the next few candles and see whether it's actually an impulsive move. For example, you get candles like this. Say this, let's see, did it break structure? Yeah, so it broke structure. So our order block is here, and there's nothing else that we need to compare it to. So our next point of interest is going to be this candle here. Okay, simple as that. So what I suggest you do is just practicing identifying your order blocks and identifying what areas of interest there are, because sometimes obviously I sometimes go to 30 seconds or 15 seconds to look for order blocks, but there's no need because we can refine our entries quite cleanly just doing this, just moving our order block, just moving our zones to the next few candles until it breaks the range, until it breaks an impulsive move. And you know that is an impulsive move because you get an impulsive move like this that actually fully breaks the range of the order block candle. So for example, let's see, we've seen a few examples at the moment, but can I see another one? Like that would be a clean one, you know, there's nothing else to compare it to. For example, here, so for example, say this bullish move created this move, okay, obviously broke structure. Our bearish candle that's creates moves, obviously this one. Let's just ignore that for the moment because we've got a reaction actually. So let's go here. Sorry. Okay. So we've obviously got a wick break. Obviously that's not the type of break that we like, but I'm just going to say that that is a break of structure, and we've got an order block here. Okay. The next candle, so we've got an order block here. The next candle that's been created obviously didn't break structure, but that's our range now. And the next candle after that didn't really do anything, it's still within the range, so that's now our entry point. And then what happens, price comes back to this entry point and then carries on going. Okay, there's obviously and there's probably an order block sitting there. So this is how to actually accurately find your order block without having to refine it from going to the different time frames. Okay, we can just do it after 15 minute. There's a reason why I'm doing it after 15 minute, because this is how we're going to refine our entry point to actually trading it. So the next few videos, what you'll learn is understanding the bit of background about it, and then we'll actually go through how to put it all together.